And we'll just wait 1 second while that boots up. Okay, and I think we are live. So, welcome back to anybody who was at the first one on my channel, and welcome for the first time for all you guys on the Trade Ideas channel, and anyone who was sleeping the other week and missed us. So, I have the Trade Ideas chat room open, so if there's any questions or comments or concerns or anything, let me know. The first little bit of this course that we're doing, we're keeping pretty light so that we can hammer out any tech problems at the same time. So quickly, we're going to go through what we're doing here, which is what is a stock? And Rudy thought I was joking, but he put in some filler text here of what this was about, and I just left it. So it talks a lot about wormholes. That's not actually what we're going to talk about today, but I just thought it was funny that it was there, so I left it there. Essentially, what we're going to do. I'll introduce myself first. Michael Noss, also known as Bonpara, for a lot of you guys in the Trade Ideas universe who've seen me before. I deal with the Brokerage Plus module, the back testing, some of the automated type stuff within Trade Ideas. And if you're on my channel, or if you've been on my channel, you know that my channel has a lot to do with that heavier type material that's already assuming basic knowledge of trading. We had our summit where we went through and we talked about what we're going to do for next year with Trade Ideas and the direction we're going to go. And there was a lot of mention about some people within the company wanting to learn to trade and wanting to understand a little bit more about the product they're supporting and what they're dealing with. So we have 4 lovely people here, which we are going to take from absolute basics. None of these people have placed a trade before. A lot of them don't really know too much about the markets. I think I'm pretty safe to say that. And we are going to go from basic market knowledge, basic market mechanics. What is a stock is the name of this lesson. And last lesson was just an introduction of us, all the way through to showing them technical analysis, statistical analysis, fundamental analysis, back testing strategies, auto trading with Holly. So they're going to go from never placing a trade before to auto trading with a machine learning AI by the end of this. So it'll be pretty exciting full journey through there. So I'm going to quickly introduce everybody, and I know I said I wouldn't make you say anything, but let's just quickly go through. Hello, it's me, and this is what I do at Trade Ideas, and this is my experience with the market. So let's just go left to right here. So let's just start with Marissa.
Hi, I'm Marissa Goodbody. I've been with Trade Ideas for about 10 years, and during that time I've managed support, billing, and now I'm the affiliate manager here at the company. And during the 10 years I've worked here, I've had no experience with trading, so I'm really excited to start learning now and see what happens.
Awesome. And Kelly.
Hi, I'm Kelly Nogueira. I've been with Trade Ideas for 3 years now. I manage account and billing, and I have no experience with trading, like, whatsoever. So.
Good. Glad to hear it. And Rudy. You're on mute there, Rudy.
Hi, I'm Rudy Prather. I've been with Trade Ideas for about a year. I do graphic design here, and I have 0 experience with trading.
These are good. These are good answers that we're having right here. And Shantae, last but certainly not least.
Thank you. I'm Shantae. I work in the account and billings department. I know absolutely nothing about trading, so very excited.
Good. So you're noticing a theme here, right? The people that were the most interested were the people with the least amount of knowledge behind it, which is just fantastic. It's exactly what we want. So today we're going to go through what is a stock. And I know for a lot of you watching this is going to be incredibly basic. There's going to be a surprising amount of you that don't understand some of this. And since we're starting from the basics, then that's exactly what we're going to do. And we're going to start with what is it that you're going to be trading. And for the sake of you guys in the chat and for you 4 over there, I make these presentations short and I talk quickly, so feel free to interrupt. I want this to be a conversation more than it is just me spewing knowledge at you. Everything you're going to see here you could find on Wikipedia for the first bit anyway. So interrupt, ask questions, and let's have a chat. So the first slide here is just talking about why go through this, right? Why not just dump you into a chart or into trading, whatever, and just saying here, if it's green, you buy it, and if it's red, you sell it, and away you go. And the reason behind that is that there's a lot of things that have to do with the understanding of what you're trading, how you're trading it, how things like news can affect the company's value in the stock, things like how the value's created, what happens when a corporate action takes place. I'm sure you guys have heard of dividends and stock splits and these type of things. So if you don't know what a stock is, you won't know how these actions may affect the trading. The other thing is why a company would care about its price. A lot of people think that a company's worth or how much money they have is directly affected to their price, which is a complete kind of misunderstanding about how the system works, which we'll go through in a second. And the other thing is how officials within the company are elected. A lot of people don't know that as a shareholder of a company, you actually have the right to vote on certain things. Not many people do vote, and this is something that would be fantastic to change. But these kind of basic understandings, I think, will help out with the journey immensely. So first of all, I'm going to put someone on the spot, and since Shantae's the only one without a mic, mute it. What is a stock? What do you think when I say, here's a share of Apple? What do you think that means?
To me, it's when the company's making money, and you can purchase it, and you can make money if the company's making money.
Okay, no, it's not wrong.
You can lose money when they're losing money.
Yep.
So basically, buy a part of it.
That's
the stock.
That's exactly right. That last bit. So when you buy a share of a company, you actually own a percentage of that company. And that's really what the goal is that, even if you buy one share of Apple and that's a super tiny, 0.00000%, you own part of that company. You are a shareholder, and what Apple does and how well they do will directly represent how much money you make or lose on the company in the long run. If Apple phones start exploding, I've got a MacBook here and an iPhone there, an iPad there. If something drastically wrong happens to them, everybody who has ownership of the company is going to suffer. So when you're buying a stock, you're actually taking a bet on Apple's future, and you're owning a bit of that company, right? There's a couple things here that it actually gives you rights to. One of it is dividend payout. So what a dividend is basically a company makes a bunch of money and then it pays off all of its bills, it pays its employees, it reinvests in trying to build fancier iPhones. And then if there's money left over, what they'll do is they'll say, okay, I'm going to give that to all of the people that own the companies. And the main reason they do that is because people like Tim Cook now own a lot of the company. So they want a lot of this money, right? So as a shareholder, if you own a stock, you get part of the company's value, and you get part of, if they decide to pay dividends, you get part of the dividends. You also get voting rights on certain things, which we're going to go over later, which a lot of people don't know and a lot of people don't really act on. And
what would be a motivator for the company to pay out dividends? Why not just keep it to themselves?
Well, the main thing you need to understand is that all of the higher ups in the company own a lot of stock. So, for example, Steve Jobs was very famous for never taking a salary. He wasn't charitable in any way. He owned a lot of the company's stock. So instead of actually taking a salary, a bunch of money, he just said, okay, well, I'm going to tie my wealth to the wealth of the company. So I think it was a long time ago that Apple started paying out dividends. Before that, they kept the money. Without going into the advanced corporate finance stuff that you don't really need to know too much about, it's like a 3-year university course. It's basically a math equation for when they think they can no longer keep the money and do stuff with it, right? So if I'm in a company that's rapidly innovating its product, I may want to take the money that I have extra, put it back into the company and innovate a new product. But if I think that I'm kind of out of ideas for the short term, then I'll pay that out to the investors. The other thing comes back to the voting rights here, which, eventually the people own enough of your stock, they're just going to vote and tell you that you have to pay dividends. So it's good. Questions, I love them. So sharing in the value of the company, right? The ups and the downs, that's part of what you get as a shareholder. And then if this thing can get out of the way here, then it's a bet on the company's future. It's a bet on saying, okay, this is what I think the company is going to do in the future. I think it's going to be a successful company or a bad company in the terms of shorts. So how a corporate structure works. And again, this is high level, and a lot of people unfortunately don't vote, which gives the main holders of the company the most power. But as a shareholder, you actually get to vote on the board of directors, which is a big shadowy organization, usually a bunch of people who then elect the CEO to run the company. So,
Michael.
Yep.
Sorry to interrupt. I have a quick question.
Sure.
So is everybody's vote equal, or I own 0.001% of the stock and I vote a certain way, so it goes into like a formula? Or do people that own a lot of shares get like, instead of one vote, like 1,000 votes? How does that work?
And sorry, I'll just introduce quickly. This is Sherry Merkin. So the money manager, the one that keeps us all nice and fed. So we all bow and thanks. So Sherry and 100% right, where it's not all equal. It's not one person, one vote. It is the amount of shares that you hold represent your ownership in the company. So if I make a company public, which means that I sell most of my shares, but I keep 60% of the shares, really your vote isn't meaningful at all, right? And I think that may be what you're getting at, that
Right. So that's probably why a lot of people don't vote.
right, because if you
Unfortunately.
if you own one share and then you know that Tim Cook owns 50 million shares, his opinion is 50 million times more important than you. And that's a whole nother debate about the importance of one vote. But quite often what happens is that a company will issue more than 51% of its company. So if enough people band together, they can actually make a change. And a famous example is actually, a lot of people don't remember, but Steve Jobs got kicked out of Apple in the late 80s, early 90s. And the company almost went under. It was back when they were selling those ugly plastic clamshell MacBooks, and the whole company almost went under. And then they brought him back as kind of a last-ditch effort, and he invented the iPod, and the rest is history. So it is possible that a owner of a company can lose control of their company if they issue too many shares. But I think, for example, Facebook, I believe that Mark Zuckerberg still owns most of his company. So in a case like that, there's really not a lot that you can do. But you're right, not all humans are created equal. It's the people who own the most in this situation that are definitely created equal. So the shareholders vote in your board of directors, which is your group of people, who vote in the CEO, who then hires the staff and runs the company. But in that way, in theory, you have the power over Apple's future by adding or removing CEO depending on your ownership. So then the question is why, right? Why, if you had a good, successful company, would you get rid of some of it? Or why would you relinquish this control? So why have stocks at all? And you'll learn quickly I'm a simple man, so I really like analogies and I really like examples. So I'm sure we've all watched it's Dragon's Den up in Canada. I think it's Shark Tank for you guys, where people go in and they say, listen, I have this brilliant idea, but I have no money. And that's basically how they go. So say I have an ice cream store and it's making a whole bunch of money. And I think that if I open a second ice cream store, I can make twice as much money. I have two options to go do that unless I have the cash on hand. I can go to the bank and I can borrow money. So I have here on the left, that's your debt financing. So when you borrow money, we all know that you have to make payments. You don't have a say in the matter. Good times, bad times, you've got to pay the bank. They're first in line in terms of bankruptcy. If you go bankrupt, the debt holders get their money first and the shareholders get their money way less. As well as it can deal with your taxable income. So you can have debt, you can pay it, and you can deal with your taxable income and no voting rights, right? So that's the upside and the downside of debt. So with debt, you have to pay them all the time, come hell or high water, good times and bad, but you're not relinquishing control of your company. So you really need to understand whether or not that makes sense. Most companies out there aren't able to bootstrap themselves. You know, Trade Ideas being a rare one where the people you're hearing in webinars own part of the company. We're not yet a publicly traded company, so everything is closely knit, and that gives power and control to the leadership. In return, it just means that there's less, a big cash inflow coming in order to do things like open up another ice cream shop where you'd have to buy all the equipment and everything. So then people who aren't interested in debt or maybe can't get debt is another option as well. They go to the equity side and they say, listen, I want a lot of money because I'm Facebook and I really want to expand quickly and I want to have servers everywhere and marketing everywhere and I want millions of dollars to come in so then I can turn it around, because I would rather own a third of $1 billion company than all of $1 million company, right? And that's why most people end up going public. The benefits to equity is you don't need to pay them. If at the end of the day, after you pay all your staff and you pay all your costs, there's no more money, you don't have to pay them. They might be mad about it, but they're not, demanding money, and there's nothing you can have to do. The other thing is they are last in line for bankruptcy. If there's anything that goes wrong and you guys say, I need to file creditor protection, I need to take a break from paying you, it's the debt holders come first, and then anything that's left, which is usually nothing, goes to equity. The downside is that after tax is when they get their payouts, and then also they can vote, right? So if that situation where Steve Jobs got ousted from his own company, if you relinquish too much, there is a scenario where people can influence what you're doing or kind of get rid of you entirely. So those are the pros and cons of different kinds of equity and different kinds of financing. So these are why these instruments exist, right? And this is the main point of this lesson, is I wanted to know what you're trading, right? When you're trading Facebook or you're trading Google or Apple, you're not trading so much the company, but you're trading that ownership right, that vote right of the company itself. So when you're buying stock, you're buying it from another investor, not from Google. And when you're selling stock, you're selling it from another investor and not from Google. So they're not really too concerned with their stock price unless they want to raise more money, and that means sell more stock. So really, Tim Cook, other than his own holdings in Apple, isn't really sweating the ticks up and down in Apple. It's the other investors, it's the other market participants that are worried about it. So then here is the kind of 3 ways that I see to make money in the markets, in the equity market. So one is a long position, and you probably hear long and short a lot in the trading room and in different things. A lot of people don't understand what that means. A long position is basically just taking a bet on the company's price going higher, whereas a short position is taking a bet on the company's price moving lower. One of it, you're buying the stock and you're just hoping that Apple does well and the company goes up, and the other, you're shorting the stock, which is borrowing it from the broker in hopes that you can have the stock go down and cover it at a lower price. And we'll go more about this later. I think this is kind of confusing for a lot of people. But just know that a long position is a higher bet and a short position is a bet lower. Then the other thing is dividends, which we talked about. There's a lot of people out there that buy companies like Microsoft that doesn't really move, or energy companies, just because they like getting these quarterly dividends that they get paid out from those companies. So here's a bunch of different types of securities. We're not going to trade any of these right now, but I just wanted you to know what they are, right? So a futures contract is something, again, that Trade Ideas doesn't deal with right now because, and I'll explain the benefits of why we look at stocks a little bit later. But, you can trade wheat, and all you're doing is you're betting on what that future value of wheat's going to be. You can trade crypto, which is something that I do a little bit of myself, which is Bitcoin and these type of things. Forex, and again, these are just kind of explaining the words, are different currency pairs. Like right now, US dollar to Canadian dollar, it's about 25% more. So every time I go down to the US, I have to spend 25% more on everything in Canadian dollars. You can trade that difference. Bonds, which is kind of what we talked about below, is the company's debt. So most companies just don't go with one route or the other. They go with both. They give out some debt and they give out some equity, and they try to balance the two. And you can trade that company's debt. And if you think that Apple is a decent company and they're going to pay their debt holders for a long period of time, you can just buy Apple's debt and receive that money, as well as the fluctuations. Options is something we're going to talk about way down the road, because they are derived by stock value. So you may actually want to trade them. Excuse me. And this is something we're actually going to bring Sean on for. He's a big options guy. And they're basically contracts that derive their value on the stock's price. So they're kind of bets on a stock's price. They're a concept behind that as well. We have about 5 minutes left. I'm going to leave this screen up that has... here's my Twitter. Eventually, we're going to put your guys' social down there. Here's how you can look at Trade Ideas on Facebook, and here's how you can email us if you have any questions. But mainly, I just want to go to you guys. So do you have any questions about anything that was covered? I have something to fill the 5 minutes if we need to, but I would like to, if you want to have a conversation, have a little chat. And just note that you're all on mute if you want to say something.
I know you mentioned that you're going to go into depth on the short trade a little bit later, but that is one thing that kind of confuses me a little bit.
Okay, well, we can just do it now in this lesson if other people want to. I know it's a real sticking point for people. So a short trade involves actually 3 participants, whereas a long trade involves me and you, Rudy. So if I go to the market and I think Apple's going up, and you think Apple's either going down, or you just, you made a bunch of money in Apple and you just want to turn that into cash and buy something. You're the seller and I'm the buyer. So I would just buy the shares from you and that's it, right? And that's facilitated through the market, and we're going to go through market structure and everything in the next lesson. A short sale, essentially what happens is I think Apple's going to go down. So what I do is I go to my broker. Right now, Trade Ideas links with Interactive Brokers. So I go to Interactive Brokers and I say, I want to borrow a share from you. And to do that, I'm going to pay you a couple pennies a day. It's not a lot of money, but I'll pay you a couple bucks, here and there to borrow those shares. So now I have that share from Interactive Brokers, which I then owe to them. So I go to the marketplace and I sell those shares, right? So now I am essentially short, right? So say Apple's trading at $100. So I borrow the shares from Interactive Brokers, and then I go sell them to you. And then now you're the buyer, right? So I sell the shares to you to $100. So you buy your shares and we are done. But I still owe Interactive Brokers that share back, right? Because I borrowed it from them. As long as I have it, I have to pay them nightly or weekly or whatever it may be. But now I am short shares. So I owe Interactive Brokers a share. So at some point in the future, I have to go back out to the market, buy those shares, and give them over to Interactive Brokers, right? So I profit if the price goes down to $90, then I make $10, and then I just give that share back to Interactive Brokers. If the price goes up, and this is where a lot of people get nervous from shorting, if the price goes to 150, I still have to buy those shares, and then I have to give them to Interactive Brokers. So that's how you kind of...
timeline for that?
There's not really a timeline other than the fact that you're paying that fee weekly or daily or however they calculate it. But the other thing is you got to keep in mind is that Interactive Brokers is going to be a bit nervous, right? If I have $1,000 in my account and I sold a share of Apple for $100, they're like, okay, well, he has the money to cover that position. If he starts losing money, we can take from his cash. But eventually, if Apple goes over $1,000 a share, they're like, okay, well, you no longer have the money in your account to buy those shares and pay us back, right? So they're keeping an eye on you, and they're going to say, okay, if you're wrong enough, what they're going to do is they're just going to go to the market themselves and they're going to buy those shares and they're just going to take the money from you. So the broker is set up so that they're not really worried about anything and they don't really have that risk. So it's not so much a time limit as it is if you're wrong, you're really wrong. So what happens every now and then is you hear of somebody who shorted a whole lot of shares with a relationship that they have with their broker. And then the price spikes and all of a sudden they don't have the money to give back to their broker. So they've, destroyed their entire account and some. So shorting can be dangerous, but to be honest, everything in the market can be dangerous, right? So it's what we're going to talk a lot about is psychology and risk management to manage these things. Sweet. Any other questions for anyone else?
Thank you.
No problem.
Yeah. Is there a limit to how many shares a person can buy at a time?
So it'll be limited by a couple things. One will be how much money you have, right? That's going to be a huge limit. The other thing is how many people are out there in the markets, right? So there's stocks that we call thick stocks and there's stocks that we call thin stocks. And that's how actively they're traded. So something like Apple is traded millions and millions of times a day because everybody's interested in it and it's an exciting company and there's a lot of money that moves around it. There might be a local burger joint around you that's also publicly traded that doesn't have that hype behind it and it's not traded enough. So it's important to note that every time you go to the market to buy shares, there has to be someone else on the other side willing to sell to you. So that's going to be something we call float and liquidity, which we'll talk a little bit about later too. But it's going to be limited based off of what that other side is. So with Apple, you could go in $10 million and you could probably just hit the buy button and there'll be somebody there to sell to you. Something that's a little bit less noticeable, maybe with a few $1,000s, you're going to make a big difference. So it's really stock dependent at that point, which is one thing that Trade Ideas does a great job at is you can actually say, I don't want to see any of those stocks in which I'm going to influence the market as a small trader. I only want to trade the stocks that I'm not going to influence. And there's some people who go the other way around. They want to trade those little stocks because they move a lot quicker than the bigger guys. Make sense? Thumbs up?
Yeah.
Thumbs up. Shantae, Marissa, anyone else? We started a minute late and we're a minute late ending. So if there's no...
Are you going to be recording this so we can look at it later and review?
Yep. Everything will be uploaded instantaneously, I think, maybe an hour or two, to both the Trade Ideas channel and to my channel at Bonfire there. So, and then we're going to try to keep this time slot. One thing that we said, which I totally agree with, is that we're going to make sure that this kind of whole posse is here for the first few anyway. We might start swapping people out. People might get bored of me rambling and we'll put in another trader in there. People might be sick or have something to do. But I would stay tuned half hour after the market closes on Friday for more of these. So I think we are going to end it there. So I thank all you guys for coming, and I thank you guys for coming as well.
Thanks,
Thank you,
Michael.
Michael.
No problem.
I thank you.
No problem. I'll talk to you later.
Have a good
Bye.
All right. Bye.
Bye.